Welcome, everyone. My name is Martin McGinnis. I'm the Executive Director of CSS. With me tonight is Dave Kapeluk. Dave is manager of our member services group, and it's his team that includes our pension plan consultants, the team of designated financial planners CSS has on staff to assist members with their investment questions and retirement planning. I'll be turning things over to Dave in a minute or two to lead the presentation tonight. We also have Brent Godson with us. Brent is Director of Investments and Financial Management for the plan. We've asked Brent to join us to answer any detailed questions that may come up regarding CSS's investment funds or more in-depth questions about CSS's overall investment philosophy and policy. Kirby McGinnis, our Information and Communications Technology Manager, will be keeping an eye on things for us to help deal with any technical hiccups that might arise. And we have Nicole Quintel, Communications Manager, with us as well. Nicole is responsible for all communications, such as our TimeWise magazine, our website content, the quarterly e-digests that we send out, and she's had a big hand in helping us put together tonight's presentation. So welcome. Our plan is to spend about the next hour with you, providing our thoughts and recommendations, considerations for dealing with the impact of COVID-19 on your CSS investments and retirement plans. These are definitely challenging times for all of us. We have over 1,000 members and spouses registered for this session tonight. I think that tells us all we need to know about whether people are finding these to be challenging times. At CSS, we've closed our offices to the public, and while it's not quite business as usual, we've been very pleased with our staff's ability to continue to fully serve our members. Many of you have sent us messages telling us that, and we really appreciate hearing that. One area of our operation that has been significantly impacted, though, is our delivery of retirement income options workshops. We've had to cancel those scheduled sessions for the first half of 2020. Members approaching retirement who attend these workshops tell us the sessions are highly valued. Our practice has been to deliver those in person so that our pension plan consultants are available to meet with members to discuss their retirement plans in person, but the current health crisis has made that impossible for the foreseeable future. We've been working hard to build an effective alternative delivery of those workshops, but before we do that, we thought it more important to develop and deliver information that addresses specifically the impacts of COVID-19 on our members, especially those nearing retirement or who have recently retired. And that's why we're here tonight. Significant market disruptions like the one we're experiencing now can be very unnerving for members approaching retirement or who have recently retired. A serious market downturn just prior to retirement can throw a wrench into retirement plans. And so this presentation has been geared particularly for members age 50 and up who may be approaching retirement or who may have recently retired prior to the disruption. While it was our 50+ members who were top of mind in putting this presentation together, that's not to say that members who are younger than 50 haven't also been impacted or concerned by what the COVID-induced market disruption is doing to their CSS holdings. So we welcome all members with us tonight, and we trust that you'll find value in the presentation. Our plan is to answer questions that arise during or at the end of the presentation, and we ask that you use the question and answer feature to type your questions. We'll address them at the end of the session. Now, having said that, we are mindful that we've got about 1,000 members registered for the session. So if we get too many questions to address tonight, we'll send out more information after the session using the email address you provided to register. Dave, I'll get you to advance the slide one. So no good presentation in the investments space starts without a disclaimer. So here's ours. Two things I want to mention here. Each of you has a specific and unique situation. And addressing the specifics of your situation is not possible in a general presentation like this one. So please don't take what we're saying tonight here as advice for your specific scenario. Please contact us if you'd like to discuss your own situation. Our contact details will be provided later in the presentation. We will, and the second point I wanted to make was we will be referring to past events and market disruptions throughout the presentation tonight. While it can be helpful to look at what has happened in the past, please keep in mind that past performance is not necessarily indicative of future results. So with that, I think that sets things up for us, and I'll turn it over to Dave Kapeluk now to take us through the presentation.
Thank you, Martin. As Martin mentioned, my name is David Kapeluk. I'm the Member Services Manager for the Pension Plan. It's my pleasure to be with you this evening. I'm sure many of you have been stressed out lately by the recent downturn in the markets and what it's done to your portfolios. Maybe it's even caused you to lose some sleep. If you have already made a retirement plan, that can help eliminate some of the stress in times like this. But you may be wondering if it's still valid or if you should be making any adjustments to it because of recent market events. Or maybe you haven't made a retirement plan yet and are wondering whether you should, and if so, how do you go about it? Maybe some of you have recently transferred all your pension funds into what you consider safer investments because the markets went down and you wanted to avoid a further fall in the equity markets. Or perhaps you haven't made any changes to your portfolio at all and are wondering if you should. Well, we plan to talk about all of these things this evening. Firstly, please know that you're not alone. These are very challenging times, both from a health perspective and also from a financial perspective. And it's especially troublesome for those who are nearing retirement or who have recently retired. While this presentation may be of interest to all members of the CSS Pension Plan, it is those that are closing in on retirement and those who have recently retired that are the focus. Our objective in this presentation is to help bring some clarity to what has been happening in the markets and, perhaps more importantly, share some recommendations and insights as to what you might consider doing to help you adjust your retirement plan because of the pandemic. First, let's start with a bit of a history lesson. The following two slides look at the historical downturns of the US S&P 500. On this slide, we show a couple of graphs with some information on past bear markets and significant market downturns. When looking at these graphs, remember that past performance does not guarantee future results. But past experience can provide some possible clues as to how markets and individual investors might behave in this current crisis. The graph on the left shows 9 historical market downturns in green and the current one in red. Note that the data for the current downturn is to March 16th. And the markets have recovered quite a bit since then. But there's nothing saying they can't go back down from here and retest those lows that we've seen in March. It's important to note that, at least so far, we've seen worse downturns than we've seen recently during this pandemic. The graph on the right shows how long in days each of these past downturns lasted. Again, the green bars represent past downturns versus the red bar where we are this time. And again, the data is to March 16th, so add another 60 days or so, which means we're still likely in the early days. Two important observations here. All historical downturns have ended at some point. And there is no consistent number of days as to how long a downturn will last. Each one is different. And we don't necessarily know when the downturn is over until we're looking back at it in the rearview mirror some 6 or 8 months down the road. So trying to time when to get in and out of the markets by predicting when the downturn will be over is extremely difficult to do. And it's not something we recommend. If it was easy, we'd all be rich. Continuing to look at historical downturns, let's now have a look at the 12-month returns following each of these past downturns in the S&P 500. It's worth noting that returns have been about 30% or more in the 12 months following the end of each downturn. So if we are out of the markets when they recover or start to recover, we will miss out on some or all of those gains, and that'll do serious harm to our retirement savings. This next slide demonstrates the dangers of market timing. It shows that it's time in the markets, not timing the markets, that leads to long-term success. Here, we're going to look at $10,000 invested in the US S&P 500 for the 15-year period from December 31st, 2003 to December 31st, 2018. If you were fully invested in the S&P 500 for the entire 15-year period, and that includes 2008 when the S&P 500 lost something like 40%, your initial $10,000 investment would have grown to over $30,000. And this translates into an annualized return of 7.8%. If you missed only the 10 best trading days of that 15-year period, your $10,000 would have only grown to about $15,500 over the 15 years, or a 2.96% annualized return. If you missed the 20 best trading days, you didn't make any money during that 15-year period. Or if you missed the 30 best trading days, your $10,000 is only worth about $6,800 15 years later. And if you missed the 40 best trading days, your $10,000 is worth less than half as much. And please note that these best trading days typically happen just before the market highs and right after the market lows. Since we don't know when these highs and lows are until a number of months after the fact, someone who is trying to time the market is going to miss some of those best trading days, and that's going to affect their overall return. So the message here is to stay the course. This next slide is quite busy, but it has some important information that we'll refer to later on in the presentation. Our statistics show that the majority of you will have most, if not all, of your pension funds in the balance fund, which is the default. And as the default, this is the fund your contributions are invested in until or unless you instruct us otherwise. However, there are 3 other funds available at the pension plan, and they have been designed with specific risk characteristics and return objectives. At the top of the slide, we have the equity fund, and it provides an opportunity to earn a higher long-term average return if you're willing to accept the greater risk of a short-term loss. It's a diversified portfolio of Canadian and foreign equities, about 25% Canadian equities, 31% US equities, 43% in EAFE and emerging markets, and 1% short-term. And the equity fund is partially hedged to the Canadian dollar. This equity fund is suitable for members who are willing and able or have the tolerance to accept a greater risk of short-term losses. And on occasion, equities have been known to produce serious and prolonged negative returns. And over such periods, equities have earned lower returns than fixed income or short-term investments. Next, we have the balance fund, our default, and it's designed to provide long-term growth with moderate short-term volatility. It's a broadly diversified portfolio of equities, fixed income, and real estate investments. Approximately 55% equities, 35% fixed income, and 10% real estate. And it also is partially hedged to the Canadian dollar. Balanced fund is suitable for members seeking a moderate long-term growth through exposure to equity, fixed income, and real estate investments. And its structure is set and maintained under the plan's investment policy so that asset mix decisions aren't required by members. And as we know, the balanced fund is expected to suffer periodic short-term losses. The bond fund provides an opportunity for a more modest long-term average return with a lower risk of short-term losses, and its diversified portfolio of mainly Canadian government and corporate fixed income investments. It's suitable for members who are willing to accept a lower average return to reduce the risk of short-term losses. However, the bond fund may not produce sufficient earnings over the long term to produce an adequate retirement income. And bond prices tend to decline when interest rates or inflation expectations increase. Situations like this can cause the bond fund to suffer an occasional short-term loss. The money market fund preserves capital while providing liquidity. It's expected to produce a return similar to short-term interest rates in Canada, and it's 100% Canadian short-term investments. So it's low risk, low return. It's suitable for members who are willing to accept a low return in order to minimize market risk. It's not recommended for a long-term investment, and it's unlikely to suffer significant short-term losses. It can be used to hold funds that are expected to be withdrawn or spent in the short term. These 4 pie charts show the asset mix for each of the investment funds as of December 31st, 2019. From left to right, we have the money market fund, the bond fund, the balance fund, and the equity fund. As we move from left to right, the risk return level increases. You can see that the balance fund is a very well diversified portfolio with moderate risk and is suitable for a long-term investor, such as someone investing for retirement and also during retirement. Please note that each of these funds are unique to the CSS Pension Plan. They are only available to members of the pension plan. They are not available anywhere to the general public. So continuing with our been here before theme, let's look at how the balance fund has done in the past. You can see that the balance fund had negative returns in 2002, 2008, had a very slight negative return in 2011, and a negative return again in 2018. The 2002 and 2008 downturns in the markets were associated with the tech bubble and the great financial crisis, respectively. And 2018 is an example of how the balance fund can and is expected to incur negative returns from time to time because of its exposure to global equities. You can see that in all cases, after a negative return, we saw strong returns in the years that followed. You may find it interesting to know that during 2008, the balance fund was down over 25% at one point during the year, which is kind of what we've seen recently. So can we say with any certainty that we'll see a similar recovery this time? No, we can't. Nobody can. Each downturn and recovery is different. We also don't know if things will get worse from here before they get better. Nobody knows that either. For someone approaching retirement or who recently retired, this can be very unnerving or stressful. So what can we do? One response might be to eliminate all equities from our portfolio in favor of safer investments. Some of you may have done this. Another response is to buy on the dip or take on even more equity risk by buying low. Another might be to do nothing because we have a retirement plan in place and we're prepared to stay the course. So you can see that even with these negative returns during the 25-year period from 1995 to 2009, a member who stayed the course with the balance fund would have achieved a 25-year annualized return of 7.76%. Let's talk a little bit more about equity exposure in our portfolios. Most of you will have been invested in the balance fund for most, if not all, your careers. This slide shows the difference in the rate of return over the past 10 years for the balance fund and the money market fund. The 10-year annualized return for the balance fund is 7.42%, and on the previous slide, we saw that the 25-year annualized return after fees for the balance fund was 7.76%. These are very good results. The balance fund is a very well diversified portfolio of global equities, real estate investments, exposure to emerging markets, government and corporate bonds. And because of what it's invested in, we fully expect it to see negative returns from time to time. However, over the long term, we expect it to provide the types of returns necessary to build an effective nest egg while members are working, and to continue to provide long-term growth needed to sustain a viable retirement income. The inherent risk and return relationship of the balance fund is why we see a substantial difference in the long-term rates of return between it and the money market fund. A couple of key points to mention here are, it's important to have a retirement plan that is prepared in advance of a crisis, so it can act as your North Star when things get rough. And it's also important to keep a long-term view when you retire. You will still have 20, 30, or more years ahead of you to invest. That's a long time, and that requires a long-term perspective. Remember this slide and the previous one later on in the presentation when we talk about the need for appropriate long-term returns to grow your retirement assets sufficiently to support your retirement income needs. People often ask, how much income will I need each year in retirement? The answer to that question is, it depends on how much you're going to spend. So, do you know how much you'll spend on housing, food, and other necessities? And what about the leisure and recreational activities you plan to do in retirement? What will those cost you each year? Besides the retirement assets you are accumulating in the CSS Pension Plan, you may have other sources of retirement income available to you, such as Canada Pension Plan or CPP, and old age security at age 65. You may also have savings in RSPs or tax-free savings accounts, TFSAs, and other investments or savings. If you have a spouse, he or she may also belong to a pension plan or have RSPs, TFSAs, etc. So what you have in the CSS Pension Plan is just one piece of the puzzle. It might be a big piece, but it's still just one piece of the puzzle. These are all important considerations. So knowing how much you're going to spend in retirement will determine how much retirement income you're going to need. And knowing how much retirement income you're going to need will help determine if or when your CSS nest egg is large enough to support your retirement income, along with the other pieces of the puzzle. Once you know the required asset level for your CSS nest egg, you can assess whether you're on track to achieve it. And once you have that plan in place, you can monitor it annually or more frequently to ensure you're staying on track as market conditions or your personal circumstances change. Over the next couple of slides, we're going to look at the output from our online basic retirement planner. This is a retirement planning tool available to all members through the My CSS Pen area of our website. If you haven't tried it yet, we encourage you to do so. As mentioned, over these next few slides, we'll look at a couple of examples of member circumstances. We're going to illustrate as best we can what these members' retirement incomes might look like. And we'll look at what things they might do leading up to their retirement to better position themselves. Example one here is a 64-year-old member planning to retire next year who is very nervous by a recent drop in the markets and their CSS nest egg this close to retirement. This member has been contributing to the plan for about 34 years and currently earns $37,500 per year. They've accumulated about $250,000 in the pension plan and do not really have any other assets saved for retirement. This member is expecting to receive CPP and OAS and has determined that they need about 70% of their pre-retirement income to live comfortably in retirement. The chart on the top right of the slide is the output from the basic retirement planner. It shows that, along with the income expected from CPP and OAS, the member currently has sufficient assets saved to achieve their retirement income objective. The orange bar shows that even with a below average market outcome, the likelihood of the member having required assets is very good. So what should this member consider with respect to protecting their situation? First, they need to think about what retirement income product or products they will use in retirement. Do they wish a traditional monthly pension or annuity, whereby they will receive a fixed monthly payment for life? Or do they wish a variable benefit or a RIF type payment, where they continue to manage their investments and the risk that comes with that for the potential to receive a higher monthly income than the traditional monthly pension or annuity? If they're thinking of the traditional monthly pension, then they should consider protecting or preserving the retirement assets they've already accumulated by moving most or all of their pension funds into less risky investments, such as the bond fund or the money market fund, as they likely don't have the opportunity to recover from a market downturn. Or if they're thinking of the variable benefit payment, then they should consider creating a spending reserve of 1 to 3 years worth of retirement income by transferring this amount of money into the money market fund. We'll talk more about this later on. This example here, example 2, is perhaps a tougher scenario. Members in this type of situation will likely need to maintain some equity exposure in their retirement portfolio. The differences between example 1 and example 2 shows why you should have your own retirement plan, because everyone's situation is different. In this example, we'll look at the impact of holding a very conservative portfolio with very little equities versus a growth portfolio that holds considerable equities. So let's have a look at this hypothetical member with the following characteristics. So this member is 54 years old. They plan to retire in 11 years at age 65. Been part of the pension plan for about 30 years. Current salary is $100,000 a year and has about $450,000 in the pension plan. And their required income in retirement is 60% of their pre-retirement salary. And in the bottom left corner of the slide, you can see the composition of the various portfolios we'll look at. So we've entered the parameters into the basic retirement planner tool, and we've selected a conservative portfolio for this member because we've assumed that this member became very distressed by the market downturn and decided to move to a conservative portfolio, holding 55% in the bond fund and 45% in the balance fund. It's important to note that this member still has some equity exposure through the balance fund. So this portfolio isn't nearly as conservative as one where the member may have moved all of their funds to the money market fund or the bond fund. The output from the basic retirement planner tool shown in the top right of the slide shows that this member is most likely going to fall short of the assets required to generate the retirement income they're going to need. And if we incur poor or below average market outcomes in the years ahead, the member may fall even further short. That's the orange bar. The chart at the bottom right shows the output if the member chose to invest more aggressively by choosing a growth portfolio. That is 80% balance fund and 20% equity fund. In this case, the member is predicted to achieve the required assets needed, but given what we've just seen in this market downturn, do they have the tolerance to increase their equity exposure and the potential downturns this many years from their retirement? So what happens if the member stays 100% invested in the balance fund? Again, they come up short in the most likely scenario, the green bar, and significantly short if we encounter poor or below average market results in the years ahead. So what can we do to change these outcomes? The graph on the top right shows the likely outcome of delaying retirement by 1 year. The required assets are achieved in the most likely scenario, but still fall short if market returns are poor or below average. The chart on the bottom right shows the likely outcome of continuing 100% in the balance fund, but also contributing another $250 a month as an additional voluntary contribution. Here, the required assets are achieved in the most likely scenario. Each of us has our own personal situation, which may or may not match what we just looked at. That's why it's important to do this exercise for yourself, preferably while you still have time to make changes if you find you're not on track to achieve your retirement objectives. Although not perfect, this does give you a bit of a glimpse into what the future might hold. And if you review this each year as you approach retirement, you can see if you're tracking toward or away from your target and can make any adjustments as necessary. Now, let's say you've already done some retirement planning and have just realized this market downturn has put your retirement plan off track. Perhaps you're thinking, what will I do if the markets drop even further? Is the volatility in the equity markets keeping you up at night? First thing is, don't panic. There are some possible remedies to consider. As we looked at earlier, remember that your time horizon is most likely long, unless you have a known health issue that will impair your life expectancy. And remember what has happened during past market downturns. There's no guarantee that this time it'll turn out similarly, but history suggests the markets should eventually turn around. Talk to an expert. Contact one of our pension plan consultants for assistance or an accredited financial advisor at your credit union or bank. It's difficult not to let our emotions get the better of us during times like this. So having an informed, objective voice can be very helpful to keep you on track toward your retirement objectives. Statistics show that investment decision mistakes often happen when investors let their emotions get the better of them. Now, what should you do if you already panicked and you eliminated or significantly reduced your equity holdings? First, use the basic retirement planner tool we discussed earlier. If the output suggests that you likely won't have the required amount of retirement assets to generate the retirement income needed, you'll need to devise a plan to get back into the markets. This can be tricky, so we suggest you might seek the help from an expert. But one way of increasing your equity exposure is to do it in stages rather than all at once. This helps eliminate the risk of being 100% wrong on when to get back into the market. And by using this strategy, you average back into the markets. Again, trying to time the markets is not something that we recommend. What if you already have a retirement plan? You didn't panic, so you've stayed invested with an appropriate exposure to equities, but your plan shows that you're likely not going to have the required amount of retirement assets to generate the retirement income you'll need. A few considerations. If you're very close to retirement and therefore do not have time to let markets recover fully by the time you plan to retire, you should consider working longer if you can. This will provide more time for your pension funds to recover and grow. If you have other sources of retirement funds outside the CSS Pension Plan, you may wish to draw on those first to allow time for your CSS nest egg to recover and grow before you start drawing on these funds. Or you may have to alter your retirement income expectations. If your retirement date is not imminent and you have time, say several years before you plan to retire, you may consider increasing your regular savings. One final strategy we want to cover off, as promised, is the spending reserve. The spending reserve is a portion of your pension funds that you invest very conservatively, so there is no risk of it being affected by a significant downturn in the markets. If you plan to go with the variable benefit option at retirement, we suggest you consider holding 1 to 3 years worth of retirement income in the money market fund, and that you make your retirement income withdrawals from the money market fund. Then each year when markets perform well, you would replenish the amount you withdrew from the money market fund from your growth investment, such as the balance fund. In the years when the markets don't do well, you would not transfer out of the balance fund to replenish the money market fund. Once the markets recover, you would then replenish the money market fund by transferring from the balance fund. Let's go through an example of how some members use the money market fund for their spending reserve. Let's say we have a member who has decided they want a spending reserve of 2 years worth of retirement income in the money market fund. And according to their retirement plan, it indicates their variable benefit withdrawal is going to be $1,000 per month. So this member is going to have $24,000 in the money market fund at retirement for their spending reserve. When they retire, they set up their monthly variable benefit withdrawals to come from the money market fund. Then, after a year has gone by, let's say, they look at how their balance fund investment has done. And let's say the markets were good and the balance fund had a good return. So they replenished the $12,000 withdrawn from the money market fund by transferring $12,000 from the balance fund to the money market fund. So they're now back at $24,000 or 2 years worth of withdrawals in the money market fund. Now, another year goes by with $1,000 coming out of the money market fund each month. And let's say this past year, the markets were down and the balance fund had a negative return. Not to panic, because we still have $12,000 left in the money market fund or 1 year's worth of retirement income. So we can leave the balance fund alone and let it recover. By using this spending reserve strategy, it helps to avoid being forced into the situation of having to take money from the balance fund when the markets are down. In other words, selling low. Ideally, we want to take money from the balance fund when the markets are up or sell high. This is not guaranteed to work all of the time. It could break down if we had a multi-year downturn where we saw negative market returns for an extended period of time. We suggest you start establishing your spending reserve for your variable benefit payments when you're 3 to 5 years from retirement by transferring a portion of your pension funds from the balance fund each year into the money market fund, so that when you retire, you have your desired 1 to 3 years worth of retirement income in the money market fund. Also, keep in mind that with the variable benefit option, your annual investment returns will fluctuate from year to year. So you should be prepared to adjust your retirement income withdrawals accordingly. Again, seek the advice of an expert to help you with these decisions. The experts can't guarantee your outcome, but they can provide guidance. So in conclusion, don't panic. We've seen downturns before. We can't guarantee we'll see a recovery this time, but history shows that we always have in the past. Have a plan. Everyone needs a retirement plan. It doesn't need to be complicated, but it should guide you as to whether or not your retirement assets will be enough to support your retirement income needs. This will be a bit of a crystal ball for you, an imperfect one for sure, but it'll let you know if you need to make adjustments as you approach retirement. Be flexible. Nobody can predict the future, so we need to be ready for whatever lies ahead. Monitor your retirement plan periodically, probably at least annually, especially as you get closer to retirement, so you can look into that crystal ball from time to time to see if you need to make adjustments. Consult an expert. This stuff is not overly complex, but it's not easy either. So the decisions you make can have a very significant impact on your retirement. You don't have to take the expert's advice, but it certainly won't hurt to hear what they have to say. So now it's time for our question period. We'll be answering some questions that we received throughout the course of the presentation. If you have any questions afterwards, please don't hesitate to contact our office. Here's our contact information, our email address, our toll-free phone number, and our website address. And we're here to help you make an informed decision. So I'll turn it over to Mark.
Thanks, Dave. You've given us a lot to think about and a number of good tips to consider in managing the impact of the pandemic and current market conditions on our portfolios and our retirement plans. We've received a few questions throughout the presentation, and I imagine we'll get a few more here in the coming minutes. So what we'll do is we've got Dave and myself and Brent in the room, and we're going to just hand out the questions to who we think is the appropriate person to respond to them. So first, I'll just say there's a few questions that have come in that are, I'd say, are specific to like a unique situation of the member. So, for example, can I retire on a certain date? That sort of thing. Other questions around, I've got extra money. Does it make sense to pay down my mortgage or put that money towards my retirement account? I think those types of questions are really best answered one-on-one with our pension plan consultants. And so what I would recommend is that you give us a call, and so that they can look at your whole financial picture with you and help you decide on what the appropriate outcome or answer is to those questions. We did have a question on, a couple of questions actually on investments. The first one being whether CSS is making adjustments, Brent, in light of what's been going on in the market to our portfolios.
So let me start by saying what we have done. We have been rebalancing the portfolio back to its target weights and equities. So that means we have been selling some of our other assets as our equity portfolio fell, and buying equities. And in doing so, positioning the portfolio back to its target weight so that when, as Dave said, those good market days do come along, the portfolio is ready to take advantage of them. What we don't do is attempt to take tactical or opportunistic positions in the short term. We don't believe we have a good probability of success in those types of strategies. Instead, we stay committed to our long-term strategy because that's where we think we do have a high probability of success.
Thanks, Brent. Dave, a couple of questions around how long somebody can stay in the plan. So is there a date such as when I turn 70 or some years after I retire that I need to exit the plan?
Okay. Yeah, we do get that question asked from time to time. And the answer to that is you can leave your money in the pension plan just parked, continuing to grow up until the end of the year you're 71. Sometime before the end of the year that you turn 71, you have to convert it to a retirement income, that being a traditional monthly pension from the plan or the variable benefit option from the plan, or transfer it out to a retirement income vehicle with the financial institution. When somebody leaves their employer, the credit union or the co-op, for example, because they're retiring, they don't have to start drawing on their pension funds right away. Again, they can leave their money in the plan up until the end of the year they turn 71. So perhaps people in those situations would have other assets or funds to live on and just leave the CSS funds parked for the time being till some date in the future.
Good. Thank you. And while I got you, I'm going to ask you one more.
No, I won't go too far.
You did such a good job. Just a quick question about whether a member can move other assets into their CSS account.
Okay, another good question. For members who are actively contributing to the plan, so still working for an employer member of the pension plan and contributing, those members can transfer in other assets that originated from another registered pension plan. So that money could still be with that other registered pension plan, or the money could have been transferred out from that registered pension plan into a locked-in retirement account, a LIRA, with a financial institution. So we can accept that transfer in of the LIRA or the registered pension plan.
Good stuff.
For inactive members, people who are not contributing to the plan anymore because they're not working for a credit union or a co-op anymore, but they still have money in the plan, in addition to registered pension plan funds or locked-in retirement funds, LIRA, we can also accept the transfer in of our RSPs. If anybody wants to explore that, get in touch with us and speak to one of our pension plan consultants, and we can help you with that process.
Good, thanks, Dave. A couple of quick ones. What is the percentage that's charged for administration of the pension? So that fee, which we call the MER, or the management expense ratio, is different depending on which fund you're looking at. But for most members, they have their funds in the balance fund. In 2019, the MER was 38 basis points, or 0.38%. And the question, how many times am I allowed to adjust my portfolio, Dave?
Well, we've recently launched an investment instruction feature on the My CSS Pen area of our website. So if you're set up to log into your account through the My CSS 10 portal, you can go online and change your investment instructions as often as you like. And there's no fee for that. We do caution, as you know, about market timing. So even though you can change as often as you like, we discourage people trying to time the market. Those people who don't have access to a computer and can't do the investment instructions online, you can also submit investment instructions paper-based. You scan and email or fax those into us. And for those, you get 2 free paper investment instructions per calendar year.
Thanks, Dave. So we've got a couple of questions come in around real assets. What that actually, what real assets are? Is that hospitals, warehouses, that sort of thing? And are these just in Canada, or are these international investments that CSS makes? I'm going to leave that for Brent to answer.
Okay, the only real assets that we have within the portfolio is real estate. We have a portfolio of direct investments in Canadian real estate, as well as a portfolio of global REITs, or real estate investment trusts. Those trade on the stock market, whereas the direct investment in real estate here in Canada is purchased directly of land and buildings, which includes residential housing, office, retail, and industrial space.
Good, thanks. Thanks, Brent. But actually, one more for Brent here. I think we'll got him is a member asking, they're interested in how we go about, I guess, assessing our investment manager performance, and how we make decisions about exiting or terminating a particular manager and perhaps taking on a new one. So just, you don't have all night to answer this one, Brent. So
okay. So probably, we have both quantitative and qualitative metrics that we look at to evaluate our managers. So the quantitative, the common ones are we compare them to benchmarks, which in the equity market would be the TSX 300 here in Canada, or the S&P 500 in the US, that sort of thing. So we compare them to those cap-weighted benchmarks. We also could compare them to their peer groups, those groups that are, or those managers that are using the same investment style as they are, and how they're doing in comparison to those, as well as qualitative metrics. What's their investment style? What's their investment philosophy? What about their key personnel? Have we seen any changes in any of those characteristics? Those are all things that we look at. And probably most importantly, we look at them over the long term. So although we monitor these managers month to month and quarter to quarter, it's really an assessment over the long term that we look at, because we know even the best managers can underperform in the short term.
good stuff. Thanks, Brent. So just a couple of more housekeeping. Question about whether or not we're going to be providing a copy of the slides to participants. Our plan tonight is the presentation is being recorded, and so we're going to make that recording available through our website over the next few days. So watch for that. And I know that Nicole, our communications manager, will be sending out an e-digest, so an email blast to members to let them know about that link, along with other information about the plan at the same time. So just keep an eye out for that. Dave, question here about what's happening with the minimum RIF payment. So federal legislation, how that's changed in light of COVID. So just more of a general question about how the minimum RIF payment's been.
Yeah, for members, well, there's a minimum payment that is required to be taken for retirees if they have a RIF through a financial institution, or a variable benefit payment from the pension plan. And that RIF minimum, or the variable benefit minimum, was reduced by 25% this year to allow retirees to preserve their accumulation by allowing them to withdraw less from their account, rather than to help preserve what they had accumulated. So the minimum for variable benefit payment recipients, that kicks in after age 71. So those variable benefit recipients that are older than age 71, they have the option of continuing with the normal minimum, or reduce it to the new minimum, or withdraw something higher than that minimum.
Good, thanks, Dave. Couple questions in here just around accessing the pension plan consultants. Is there a fee associated with that? How do, what's that process look like for members that are looking for help from a pension plan consultant?
Yeah, our pension plan consultants, basically our goal is to help our members make an informed decision. So we're not motivated by commissions or sales targets and all that sort of thing. So our goal is to help our members make a decision that they feel is best for them. And we can help you with providing you with income illustrations. What might your retirement income be X number of years down the road if you continue working at and contributing at the level you are now, things like that. We can basically help you with any questions you may have about your funds in the pension plan.
Good, thanks, Dave. There's a question in here about, actually there's a few questions again about, age 70, age 71. But one of them in particular is about whether or not members have to go to a fixed pension if they stay in CSS. And so maybe we can just talk about variable benefit versus pension.
So if, as we've already discussed, sometime before the end of the year, you have to convert your funds in the CSS pension plan to a retirement income. So that can either be the traditional monthly pension, which is an annuity type payment, or the variable benefit option, which is a RIF type payment. If somebody starts a variable benefit payment before age 71, then they've converted that to a retirement income. So they don't have to worry about at the end of the year they turn 71 having to do something with the money that's in their variable benefit account. Same thing with the pension. If it's set up sometime before the end of the year of 71, then they've met the Income Tax Act or Canada Revenue Agency regulations of starting a retirement income before the end of the year they're 71.
Thank you. Brent, a question about prior to the pandemic, was CSS invested in Air Canada, WestJet, or any of the Canadian banks? And if yes, have any of these investments recently been sold?
So those decisions in terms of which stocks to invest in and when to sell or when to buy those are made by the investment managers that we engage. I can tell you that we did have WestJet within the portfolio, Royal Bank, TD Bank, CIBC, Bank of Montreal. I'm not sure about others. I do not believe they've been sold out of the portfolio. The investment managers we engage are largely long-term, have a long-term philosophy, very similar to ours, and tend to hold their positions for up to 5 years or beyond. So again, not selling in reaction to short-term market conditions generally.
And actually, while I've got you, Brent, there's another one here that I think would be a good question to answer, and that's what's the difference or advantage of the balanced fund versus the S&P 500? So just explain what's generally what's held in the balanced fund versus the U.S. index.
So the S&P 500 is the market cap index for the U.S. equity market. So it's large cap, U.S. only stocks. Our balanced fund is a much more diversified fund. So in terms of the equity portion of the portfolio, it's about 55% of weight in the balanced fund. It includes a piece of the S&P 500 large cap, but also a small slice of the S&P Russell 2000, which is a small cap or small stock index. It includes Canadian equity funds. It includes international equity funds around the world. It includes emerging market equity funds. So much more diversified just within the equity portion of the fund. In addition to that, it has fixed income investments, Canadian bonds, emerging market debt, global bonds to some degree, Canadian mortgages. It also holds, as we mentioned, real estate, both direct and indirect, again, globally. So much more diversified, much less volatile than the S&P 500 by itself.
Good, thanks. Okay, I'm mindful of what time we're at. We're almost at 7 o'clock, and we did say we were only going to keep you for an hour, so we want to be respectful of people's time. What we will do is there are still a number of questions here that we haven't answered tonight, and so our plan is to write up responses to the questions that we haven't addressed, and we will send those out by email to everyone who is registered for the session tonight. In the meantime, if you have a question about your own situation that needs a quicker response, please do not hesitate to contact our office and talk to one of our pension plan consultants. They're here to assist you with your investment and retirement planning questions. So that wraps things up for tonight. I'd like to extend thanks to the CSS staff and management who assisted in putting together and delivering the presentation. And on behalf of everyone at CSS, I'd like to extend thanks to all who joined us tonight. These are certainly challenging times, and we appreciate the opportunity to provide our thoughts on what to consider in adapting to the market conditions we're currently facing. And so in addition to the question and answer information that we're going to send out, you're also going to be receiving a brief survey by email. I assure you it's brief, and we'd really appreciate if you take a minute or two to complete it when you receive it. Your feedback is very important for us to ensure that we can continue to deliver information that you value. So in closing, let me leave you with the thought that I share with my team here at CSS as frequently as I can, and that's to go wash your hands and have a great night. Thanks, everyone.